So we were discussing this average rate of return. So one can say in the second year he got 16.67%. In the second year he got 25%. Now I'll average these out and I'll calculate the rate like that. So what I was trying to point out was that also comes to 20.08, 20.8% like a cell shade. Actually, there could be other approaches also. So here is a complication when you have different cash flows in different years, there could be so many approaches. So there is a standard one that they have actually fixed that we have to do. What they have said is, you know what, if you have different years, you average the cash flow of each year and you also average your initial investment. What they have said is you average your cash flow, you average your initial investment. One will ask, okay, cash flow we know in whichever how many years, 2 years are there, so we simply divided by 2. If there would have been 3 years cash flow, you would have divided by 3. But how about initial investment? How do we calculate the average of initial investment? What they say is your initial investment in the beginning is 12,000, in the end is 0. So you take it like that. So basically 12,000 divided by 2. So what this says, you do 12,000 divided by 2. So you divide 2,500 divided by 6,000. That comes to 41.67%. Did everybody get it?
Yep.
Yeah. So it's basically, if you think about it, there could be so many other approaches. So we're just following this one is because they have made it standard so that everybody who is doing this analysis, they all will be at par, that they'll be doing the same analysis among all of them. Now, now that we have discussed this, now we already know in the project P, we have initial investment of 10,000 and cash flow, we have figured out 3,000 for each year. Can somebody tell me what is the average rate of return for this one?
$15,000 divided by 5,000.
3,000.
We have to take PAT, right? So we like
just
5,000 by
yeah
5,000.
Yeah, I just saw that. I just saw that. Yeah, you are right. We have to actually take PAT. So here average rate of return, when they're saying, they're actually not talking about the cash flow. Instead, they're talking about the net profit that we have. Yeah, you're right. So little change in what we were discussing. Instead of cash flow, for average rate of return, we are taking the profit after tax. That means the net income that we are calculating, that 1,200 in this example and others. So basically that comes to 1,000 per year. So 5,000 divided by 5, whether you do or you do take 1,000 only, it's already information is there. So you can take that. But the other one is the same that we discussed. The average investment is 10,000 divided by 2 only. Any doubts, guys?
Dheeraj, where did we get the denominator? We have 1,000 as numerator.
So we denominator is your average investment. So similar, how you were doing it here is 12,000 is nothing but your investment, right? From 12,000 we are getting 1,200. So we are dividing 1,200 divided by 12,000. So here initial investment is how much?
Oh, okay.
10,000.
10,000. So
But
we
when
have
we'll be taking average, so 10,000 divided by 2.
got it.
Yeah.
Thank you.
Yeah.
It should be 10,000 by 5, no, Dheeraja, because it's
Why
5
did
years.
we divide by 2?
I'll tell you the logic. So again, nothing is a correct answer here. So they have just standardized a particular formula. That's all. When you think about it, in 5 years, initially you had the investment of 10,000. Okay. After 5 years, what is your balance investment? It's 0. Suppose. So in the beginning of 5 years, you had 10,000. In the end of 5 years, you had 0. So when you average these out, you do 10,000 plus 0 divided by 2. So you're ignoring the years there. But you're absolutely right. I mean, when you divide by year, that gives us the correct average. But like I said, nothing is a correct answer. They have just standardized a formula and they have done it like that. I think we discussed this in the class also, this one. Is that clear?
Yeah, Dheeraj, I got it.
Yeah, yeah.
So basically, we will always have total investment divided by 2.
Always two, always two. So your PAT, that is net income divided by number of years, and average investment divided by 2, always. So here in the first project P, 5,000 divided by 5, that comes to 1,000. Your 10,000 divided by 2, that comes to 5,000. So 1,000 divided by 5,000, that comes to 20%. Similarly for project Q, PAT, that total comes to 5,500. That divided by 5 is 1,100. 1,100 divided by 5,000. 5,000 y exactly similar with 10,000 divided by 2, that gives us 22%. Is that okay? Any doubts, guys? Okay. So I was thinking of having a discussion only till 7 o'clock, not beyond that. We will see how much of we can cover by that. Otherwise, we will continue tomorrow only. Is it possible for everybody to join tomorrow morning? Is that okay?
Yeah, fine.
What time?
Um, Time we can decide among ourselves. That's not a problem.
I'm okay. I'm available.
Okay.
No problem.
Cool then. So maybe 8:30, 9, something like that. I'll decide and I'll send that invite. We'll try both the times tomorrow, morning and evening, because we have too much to cover. And sooner we cover, more time you have for practicing. So better we utilize the little time that we have got. Now that we are done with the average rate of return. So basically what we calculated now for everybody, it is average rate of return only. So you simply divide your net income by number of years and divide that by average investment, you get the average rate of return. Now,
So higher average rate of return is better and lower payback period is better.
I was about to say exactly the same thing. Good one. Now, let me ask everybody else, instead of saying, when you talk about average rate of return, suppose today somebody comes to you and tells you, you know what, I have a thela, and if you invest in that, I'll give you rate of return of 15%. Somebody else comes to you and he tells, I have a idea of cafe. If you invest in my business, I'll give you 20%. Which one will you invest in?
Yes.
20%.
20%. So that means very simply, logic is, when you are looking at average rate of return, higher is the better. Let me give you the exactly same example in using the payback period. Suppose somebody comes to you and tells, I have a thela idea and you invest in my business. I'll return your full money in 2 years. I'll return your full money in 2 years. Somebody else comes to you, I have a cafe idea, you invest in my business, I'll return your money in 1.5 years. Which one is better? Shall I repeat that?
Just 1.5 years.
Did everybody get it? So what is the difference between the logic, so that it's easier when you go by example to really look at it. Otherwise it's slightly confusing when you are compiling all the indicators. So basically in payback period, you are judging in how many years you are getting back your money. So when you look at it, lesser is actually better. So for payback period, lesser is better. For average rate of return, higher is better. Is that okay, everybody? Any doubts?
Clear.
Awesome. Now, quickly going back to next one, that is NPV. NPV is nothing but net present value. We have actually done this in the last, whenever we had the discussion a long time back, before CIA 2, I think. So then we were discussing the present value, future value, how to calculate present value, and so on and so forth. That's when we discussed the NPV, net present value. Does anybody recall what net present value is, or at least if not that, then how do we calculate present value? Can somebody tell me what is present value? Rather, let me start there.
If I invest some money today
Yeah.
with a particular way of, so what will be, suppose I'm looking at 10,000 after 5 years.
Yeah.
What is the value of the money today?
Correct. Perfect.
That's what it means. So now there are different calculations, but in nutshell, it means that the value of money, which is 10,000 5 years later,
Yeah.
what is it today?
Absolutely correct. That's absolutely correct. But my question to everybody then, because I want to discuss for maybe half a minute or a minute about this. Why is it different? The money that will receive 5 lakhs, suppose after 1 year, if I have those notes today, it will be same 5 lakhs. No, why the value will be different?
Because if we had invested it, we would have got a greater
Point.
amount.
Absolutely correct. Anybody else? Any other reasons? There could be actually multiple reasons for it.
Depreciation.
Depreciation, no. The why depreciation? How? Can you elaborate
I
a little
mean,
bit?
so basically because of inflation and other things, the value would
Yes,
have gone
inflation
down,
is
right?
actually correct answer. Inflation is
Yeah,
absolutely
inflation.
correct. Yeah, yeah, I totally agree. Anybody else? Any other ideas? Why the money will be different? So when you judge money, whenever you judge anything, you have to have a parameter. Okay. No, if you are judging money, let's take a parameter. Um, in 10 rupees, suppose you are able to buy one pen. So let's make the pen one parameter. So in 10 rupees value is one pen, suppose today. So after 1 year, it is absolutely possible that same pen, for buying that, you will have to invest 12 rupees because the price has increased. Is that possible, everybody? Is that okay?
Yes.
So,
Yeah.
that, what does that mean? That means the price of pen has increased, right? Do you agree? Now, if I say the same sentence in another way, instead of saying price of money has increased, price of pen has increased, I can also say value of money has decreased. Because 10 rupees was giving me one pen today, but the same pen, for getting the same pen, I have to invest 2 rupees more now. That means the per rupee value has decreased. Does everybody agree with it? Are you able to connect the dots? The slightly a different way of thinking. I'll just repeat that with another example for everybody's benefit. Suppose you are the one building, one land price is 1 crore today. Suppose one land price is 1 crore today. For buying the same land after 1 year, suppose you have to pay 1.5 crore. So one will say that the land value has increased, land price has increased. One can also say the value of money has decreased. Both are same thing only. If you think about it, both are the two sides of one coin. So basically 1 crore was worth enough to give me a land today. However, same land is costing me 1.5 crore after 1 year. So basically the value of 1 crore today is equal to value of 1.5 crore 1 year after. Is everybody able to connect? Any doubts? That means that definitely there is something is happening. The value of money is changing. So, which is exactly why this problem arises. So, if we are receiving 5 lakh 1 year from tomorrow, doesn't necessarily mean that we'll be receiving 5 lakh today. So, what is the value of that 5 lakh today? That is what is called present value. So, I have told you, present value is nothing but value at present. Future value is nothing but value at future, right? So, we calculate the value at present. So why all of this discussion is important right now? When we are doing capital budgeting and we are calculating NPV, which is called net present value, we calculate what is the net, what is that amount of money that we are supposed to receive today. You know, whatever money that we are receiving in the next 5 years, if I would have received its equivalent money today, I'll repeat that. Whatever money that we are receiving the next 5 years, if I would have received equivalent money today, would I have made profit? You know, doesn't that make sense? That would actually benefit us in deciding whether we should make this investment or not. So if I tell you, you know, if you invest 1 lakh today, I'll give you 1 lakh 20 after 5 years. So you simply go and look, you know, what is that equivalent amount of money of that 1 lakh 20,000 after 5 years for today? If that is less than 1 lakh, will you invest?
No.
No. If that is more than 1 lakh, you will definitely invest. Right? So you calculate the present value of your cash flows and you compare it with your outflows for calculating the net present value, so that you can take a call. We will see. The thing will get more clearer as and when we'll be practicing this question. Now that we have discussed that, if you're having any doubts, please stop me and ask whatever you have in your mind, or you want to discuss anything, that's also fine. Now, next question is, how do we calculate the present value? Can somebody remind me, how do we calculate the present value of any number?
That is the investment multiplied by the PVIF.
PVF.
Absolutely correct. Now that we are going into that table thing, you know, let me ask you one more question. What is the difference between PVIF and PVIFA?
One is annuities. The other one is
Every year.
Absolutely correct. Actually, whoever is having little doubt about this, we have already covered this in the last discussion. Just refer to that video. That should be pretty much clear. That's why I'm asking you. I'm not telling you from my end. So PV, I think Anvesh has said, right? The annuity thing. Okay. Okay. Awesome. Saurav also. Awesome. Basically, PVIF is when you have one amount in 1 year. PVIFA is when you have multiple amounts. Same amount you are receiving in different years. Both actually do the same thing. Both give you the present value. It's just the scenario is different. In one scenario, you have one value. In another scenario, you have continuous value. That is what is called annuity. When you receive 5,000 every year, that is what is called an annuity. So A is used then. Now, having that said, we in this case, let's talk about the project P as of now. In the project P, we have cash flow of 3,000 in all the 5 years. Now, somebody please tell me what is the present value of project P. We'll just complete the NPV and we'll wind up today. Can somebody tell me, how do we approach this? How do we calculate the present value for project P?
We need to find out at what interest rate we want to do
Absolutely
it, right?
correct. Let me go back to the first paragraph where I told, you know, some other information are important. Look at this sentence. The company's required rate of return in 10%, each 10%. So our rate of return is 10%. Is that okay, everybody?
Yeah.
Yeah. Now you have to calculate the present value of project P at the rate of 10%. Now, how do you go forward? How do you do it? That's my first question.
So we'll multiply with for 10% and 2 years, and then 10% for 3 years.
That is one of the ways. So what will you multiply? 3000 with that factor, right? That's what you're saying?
Yeah.
Anybody
Yes,
else?
yes.
Can somebody? Yes, please. I was about to
we
ask
do
that.
this 5-year annuity factor we can take, right?
Correct. Absolutely correct. That's absolutely correct. I was about to ask the same thing only. I was about to ask, is there any other idea that somebody is getting? So you already told. And everybody is able to connect to that. So this is nothing but annuity. So annuity is when your amount is repeated every year. So here, if you see, amount is actually same and it is repeated every year, 5 years. So we can actually use the annuity instead of the normal one. What will be the difference between the two? In the first one, it will take a little bit more time, but it'll give you the same answer. You can actually try and experiment. It'll give you the same answer. And annuity, you just have one number, you multiply and you're done with it. You will save a little bit of time. Have you guys done it? Or do you want me to show you the factors? Or do you have the table?
You can show the practice which we did below, I think.
Oh yeah, it's there. So here are the factors. The answer is already there. So this is done exactly the same way that Anvesa said. You take 3000, you multiply them with each of them, and you calculate the present value. And once you have multiplied, you simply add and you calculate the total cash flow, which comes to 11,370 for project P. And similarly, in project Q, it comes to 11,767. Before
when we do year wise, then we will not take annuity. That we will go for present value factor only directly, PVIF.
So you have to know which table to look at when you are solving question like this. When you are taking the annuity, there is a different table for PVIFA. When you are taking the simple one, the year one, you have to look at the table called PVIF. If you are having doubts about this, just refer to the video. We have in detail discussed about this in the last video. It's there in the group only. You have said absolutely correctly. When you are doing like this, we'll be taking the PVIF only. Very quickly, so that you won't make any mistake. No, whenever you are taking PVIF, just have a check in your mind. This factor will never be more than 1. What I said, I'll repeat that. Just have a check in your mind in case you'll be making mistakes. No, when you are doing PVIF, that yearly one, the factor will never be more than 1. However, when you are doing annuity, PVIFA, that can be more than 1. Is that okay, everybody? Yeah. So
Dheeraj, by logic, I understood why PVIF will be lower, because it is only in the same year that you get the same amount of money, and in the future it get decreased. But for PVIFA, what is the logic if we think about it practically?
PVIFA, you mean annuity?
Yeah.
So
how
that's
is it more
because
than
I'll show you why. Tell me, what is the PVIFA for 5 years of 10%? Do you have the table in front of you?
Let me look it up.
Yeah.
We cannot use PVFIA for project Q because the annuity amount is different every year.
Very good point. I was about to ask only. You're answering before my asking questions. I was about to ask only, in project Q, can you use the annuity factor? We cannot use that. Everybody got it? What I think Saurav was saying, right?
Yeah.
So what Saurav meant to say was, because in project Q, our cash flow is not same among the years, so we cannot use the annuity one. We have to use the individual one. Anvesa, did you get hold of it? The table?
No, Dheeraj, sorry, I'm just
No problem.
googling it now.
I'll also I have it. Sure, Cell, no problem. I'll either way say oh my god, I forgot to record. I think no, I have started. I've started recording. Good. For a moment there, I thought I have not recorded. So I'll be sharing the
It's
video
a
either way.
3.79.
3.79.
Okay, you got it.
Can you
Sorry,
look
sorry.
at this number? What
Yeah.
I'm doing here?
Yes.
Can you look for
Yes.
what is the annuity rate for 10% 4 years?
Yeah.
PVIFA for 10% 4 years.
It is 3.1699.
Just look at this number.
3.1699.
Just look at my screen now. What is this value?
Oh, yeah.
Now look at 3.790,
Yeah.
3.169. What is happening? Can you see? Now this is the reason for which it will be more than one, because and PVIFA is nothing but the total of those factors.
Mm-hmm.
Is that okay?
Okay. Yeah, got it.
Yeah. Awesome. Now that we have got the cash flows from both the projects, for calculation of net present value, you simply deduct the initial investment, because you want to know how much of net value, net cash that you're receiving from a particular project. So you simply deduct 10,000 from both of them. Now you're receiving 1,370, 1,767 from project A and project Q respectively. I'll just repeat what is this NPV once more. NPV is nothing but present value of the net cash that you are receiving as of today. Present value of the net cash that you are receiving as of today. So what is this 1,370? What is this 1,767? Whatever money that you are going to receive in the next couple of years, 5 years to be exact in this question, the equivalent amount of money of that amount today is nothing but 11,370, 11,767. If we deduct the initial investment, the outflow, so net amount that will be left with is 1,370 and 1,767. Now if I ask you which one is better, more NPV is better or less NPV is better, what will you say?
More, no?
More.
Less.
More.
More.
More is actually correct. I want to know the logic of less. Somebody said less. Why less? How do you perceive it? Let me give you an example rather. Somebody tells you that if you invest in my project, then today you will receive a return of 10 rupees. Somebody else comes and tells you, if you invest in my business, today it will give you a return of 20 rupees. Which one is better?
20.
20, right? So the more is better. When you are talking about return, because this is return, right? So this is nothing but your cash inflow minus cash outflow. That means return. So more is better. Is that okay? Does that make sense?
Yeah, understood.
Yeah. Any doubts?
No. I thought future value is same for both. So
Okay.
that is why.
Okay. So we are done with the NPV part. I'll just post one question in the group. You guys try all these three. I try it tonight and let me know the answer. Let me know the answers tomorrow morning. Whatever time I'll decide, we will meet then and we'll just equate those answers. If you are wrong, that's all right. Either way, we will be going to practice that question in detail. Any doubts before we wind up?
The same question which you posted in WhatsApp, right?
No. This is a different one. I'm going to post it now. Give me 1 second. Yeah, I've done it. let me see if all the information is there. Okay, only cost of capital is not there. Cost of capital is 10%. So the rate of return is 10%. You go with that. I'll just write that down. Any other doubts? So you have to solve all three: payback period, average rate of return, and net present value. If nobody has any doubts, then we'll wind up.
So thank you, Dheeraj.
Yeah, thank you, everybody.
Thank you, Dheeraj.
Thank you, Dheeraj.
Yeah.
Thank you.